Hi everyone, we continue our discussion on chapter 10, stock valuation. Okay, so the learning objective for chapter 10 is one, we want to identify the basic characteristic and features of common stock. Okay, and we're going to use the discounted cash flow model to value the common stock. And then number three, we want to identify the basic characteristic of preferred stock. Preferred stock. Okay, so basically what is stock and shares? So if we go back to the balance sheet of the companies, we discussed before this that there are two ways of where the company get the funding. Okay, so for a private limited company or public companies, one of these way is by using liabilities. Okay, and the other one is by using their own money, or which is categorized as equities. Equities. So stock and shares is basically in equities. So for a public listed company, normally their stocks can be categorized as either a common stock, okay, common stock, and there are also certain cases where the equities may come from preferred stock. Preferred stock. So we have to be able to value the common stock or the preferred stock in order to identify the actual value of this type of equities. Okay, so let's now review and discuss generally what is common stock. The most important thing is that the common stockholder is basically the owner of the firm. So, the owner of the firm. So there is actually they will elect the BOD, the board of directors, who in turn will appoint the firm top management. So top management will then overseeing the day-to-day management of the firm. Okay, so number one, common stockholder is the owner of the firm. That's why the objective of the firm is basically to increase or to maximize the owner or the shareholders wealth. So the shareholders is the owner. Number two, when it comes to claim rights, okay, the owner or the common stockholder have the right to the firm income after bondholder and preferred stockholder. So means in terms of priority, the stockholder will be the last person to be paid when it comes to companies profitability, as well as in the event of bankruptcy. So after the liquidation of the company's assets, the common stockholder will be the last person to be paid. So the common stockholder is also known as a residual owner of the firm. Okay, so it also means that as the residual owner of the company, the right to residual income means that the potential return is unlimited. What is meant by that is that if the company record profit, okay, of course they will have to honor the bondholders first. They have to pay the coupon. The second thing, they have to honor the obligation to pay dividend to preferred stockholder. But whatever amount left, or whatever portion of the profit left, is actually all belong to the common stockholder. So there's also a privilege. We can say that there's also a privilege to common stockholder as a residual owner of the companies, in a sense that the potential return is unlimited. Unlimited. So as I mentioned before, the slide before, um, the common stockholder is the one who actually elect the board of director, who is actually the board of director will then elect the management of the company. So one of the privilege of being the common shareholders or the common stakeholder is they have the voting right. So the vote for directors and charters changes occur at the AGM, the company's annual general meeting. That is an honor for the shareholder to present there and vote for their in person. But they can also giving the authority to vote to a proxy. So proxy is actually a represented or a representative of the actual shareholder of the company. Okay, so another important characteristic of common stock is that common stock does not have maturity date, uh, and so to say that it will exist as long as the firm does. Okay, that's one. Number two is that common stock also there's no upper or lower limit of its dividend payment. In fact, there are no obligation for the company to pay dividend. Dividend. Um, but in the event of bankruptcy, the common stockholder as owner of the corporation have the most junior claim. As I mentioned to you, the common stockholder will be the last person to be paid in the case of event of the bankruptcy. Okay, so due to these two important characteristic, which is one, the stock does not have maturity date. Okay, number one, and two, there's no fixed dividend payment. Okay, no fixed dividend payment. So it is a bit difficult, or there's become an issue for us normally to evaluate the actual value of the stocks. Value of the stocks. Um, if you look back to the earlier chapters on debt valuation, when it comes to bond, what happened is that bond have a fixed coupon rate, and as well as that, the bond also have the maturity date. So the formula to value the bond is a bit easier, it's straight to the point, but not in the case of valuing common stock because of these two characteristics. One, common stock does not have maturity date, so it could be like infinities. Number two, there's no upper or lower limit dividend, but most important thing is that dividend is not fixed. Dividend is not fixed. So we have to adopt certain assumption or certain model in order for us to be able to calculate the stock or the value of the stocks. So as I mentioned in the earlier slide, there's two issues when we are valuing the share or the stocks. One, there's no maturity date, and two, there's no fixed dividend payment. Okay, so in order to evaluate or to value the common stock, so we adopt what is known as the constant dividend growth rate model. So basically in this method, we assume that dividend is constant. We have to do it like that because otherwise we cannot um, come into calculation of the company stocks. Okay, so if a firm cash dividend grow by a constant rate, then common stock can be valued as follows. So value of common stock is basically the dividend next year. Dividend next year means that dividend this year multiplied by the dividend growth rate divided by stockholder required rate of return minus dividend growth rate. So dividend growth rate here is equal to this one. Okay, so remember that this formula means that you are dividing dividend in year one, dividend next year. So this is next year. So next year over stockholder required rate of return minus dividend growth rate. So we can further summarize the constant dividend growth rate model as the value of the common stock is equal to D0 multiplied by 1 plus G divided over R minus G. Remember, there are some questions where the question is already giving the future dividend or the next year dividend. So in that case, you don't have to use this. Okay, you straight away using D1. So be careful on that. Okay, let's do some exercise on the valuation of the stocks. Okay, so look at the question. Question says that what is the value of the share? So value of the share, so it is a value of common stock that paid $6 dividend at the end of last year, and is expected to pay a cash dividend every year from now to infinity, with that dividend growing at the rate of 5%. So 5% is the G. Okay, if the investor required rate of return is 12%, so this is required rate of return is the R. Okay, so using the constant growth model, because why is it constant? Because from the question you see, you get to know that the shares is paying a constant dividend until infinity. So we can use the constant growth model to actually calculate the value of the stock now. So the formula is value of the common stock is equal to D or dividend now multiplied by the growth rate 1 plus G divided by R minus G. Okay, so what is dividend 0? Dividend 0 is $6 because it's last year, so it is actually $6 multiplied by 1 plus G. G is 5%, so 1 plus 0.005, so it is 0.5. Okay, divided by what is R? R is 12%, 0.12 minus G 0.05, 0.05. So we can get the answer 6 multiplied by 1.05 is 6.30 cents divided by 0.07, so it is equal $90. Okay, so what caused the stock price to go up and down? Okay, as far as the formula is concerned, we can identify the cause of what make the stock prices to go up and down. If you look at the formula of the constant growth model, so the formula said that okay, D0 1 plus G R minus G. So since the most recent dividend has already been paid, so it cannot affect price. So thus there are two variables, which is dr, the rate of return, and g, r and g, that will cause and lead to the changes of the stock prices. Okay, the previous slide stating that there are two factors that will impact or affect the price of the stocks. Okay, one is the R, the rate of return required by the stockholder, and G, which is the growth of the dividends. Okay, so how is the required rate of return being determined by the investor? Okay, we can use, or we can answer this question by using CAPM, capital asset pricing model, that suggests that if pre-risk rate and systematic risk beta rises, so the investor required rate of return will then also rise, and this will impact, in fact, will make or will lead to the stock price uh, to be false. So the investors required rate of return is basically determined by two key factors. One is the level of interest rate, and two, the risk of the firm stocks. Okay, so basically the CAPM formula for expected return is equal to risk-free rate plus beta. Beta is the coefficients or the risk of the respective stock, okay, and multiply by risk premium. This is a risk premium. So risk premium is equal to risk market minus risk free market. Okay, apart from the rate of return, the growth rate, or the G, will also become a determinant to the future um, um, dividend to be paid, and then therefore will also affect the price of the stocks. Okay, so the growth rate, okay, can be calculated by using this formula. Okay, this is the formula. G is equal to 1 minus D1 divided over E1 multiplied by ROE. Okay, so D1, this one, D1 multiplied by E1 is basically the dividend payout ratio. Ratio. So the growth rate of future dividend, okay, as I said, can also change and lead to change in the stock price. Okay, so the rate of growth of firm can expect future dividend. Okay, in its future dividend is a function of how much of the firm earning are reinvested in the firm. So the amount of the earning that is to be reinvested in the firm is also means that uh, the proportion of firm earning that is repeated, or no, that is retained and reinvested in the firm. Okay, so let's now go to the preferred stock, the another type of stock in the companies. Okay, the preferred stock is also known as an hybrid security. Why it is hybrid? Because it uh, it it has the two characteristics of a common stock as well as the bond or the debt. Okay, so it is actually like common stock in the sense of that the preferred stock has no maturity debt. There's no maturity debt. But in the other hand, it's also like debt or like bond, because preferred stock have a dividend amount. Dividend amount. So Furthermore, on the dividend, in general, size of preferred stock dividend is fixed. Either it's stated fixed in a dollar amount or percentage of the stock par value. Okay. In terms of the claim on asset and income, okay, the claim of preferred stock have priority over those common stockholder, over payment of dividend and settlement of claim at bankruptcy. Okay, but it is lower than the debt holder. So meaning to say, when we discuss about the priority of the claim in the events of company's bankruptcy, okay, priority number one belong to the bondholder, okay, number two is for the preferred stock, and number three on the common stockholder. That is the priority when it comes to claim on asset and income. The holder of the preferred stock also, in the case of the company did not project any or did not record any positive income, or in fact companies is recording a loss at that particular year, okay, this may lead to the preferred stockholder not being paid in terms of the dividends. So what happened is that uh, um, for the future, or the next year, if the company is recording a positive profit, okay, the company must pay first the preferred stock dividends, including the previous dividend that was not being paid during the losing financial years. Okay, so how do we value a preferred stock? Okay, so because of the preferred stock is basically a perpetuity, means the preferred stock doesn't have any maturity, and because the cash dividend is the same for every period, then the dividend stream is a level perpetuity, and therefore can be valued using the present value of perpetuity, same as the equation that we introduced or we discussed under the chapter of 6 value, time value of money. Okay, so specifically the formula for valuation of the preferred stock is that the value of the preferred stock V, okay, is equal to the dividend divided the market required yield of preferred stock, or the rate of return. So V is equal to D divided by R. So let's just do some exercise here. So let's look at the question. So what is the present value of a share of preferred stock? Okay, it is a preferred stock that pays a dividend of $12 per share if the market yield on similar issues of preferred stock is 8%. So we can use the formula that been given before. Is a perpetuity formula. So value of the preferred stock is equal to the dividend divided over R, or market yield. So it is actually $12 divided by 0.08. So the answer is $150.